Good afternoon and welcome to our High Rock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call, and I know that she's been working on lots of wealth forecasts recently, lots of new clients, and lots of work for Bianca. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we do invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, each week we quickly recap our themes for 2016 before we start on what has happened over the last week. So let's jump right in. As you all know, our overriding theme for 2016 is that financial markets will remain volatile. In January and early February, we saw a spike in volatility, but markets did settle thanks to the continued central bank monetary policy stimulus. There is still a great deal of uncertainty in the world, and as we hit the end of May, there is little that has been resolved. In fact, it could be argued that there is more uncertainty right now. The U.S. economy represents 20% of the global economy, and over 20% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. At the moment, we see a growing chance of a recession in the U.S. in the next 6 months or so, despite some more recently positive consumer spending data. Commodity prices, and especially oil, have been trending higher after a prolonged decline. Core inflation in North America has picked up a little bit, but not so much in other parts of the global economy, where we are seeing some deflationary trends continuing. We'll talk about that a little bit more later in the call. But that leaves inflation-guided central banks considering what their next actions might be. We'll hear from the European Central Bank on Thursday, and that will be interesting to hear what their next steps in their strategy will be. Well, central bank monetary policy has been at the heart of keeping volatility in financial markets lower, but now financial markets are becoming obsessed with the next moves by the U.S. Federal Reserve. Chances of a rate increase in the next FOMC meeting in June have risen. The catch-22 in all of this is that if the Fed raises rates because their goal is to normalize them, they may push an already flattening yield curve flatter, and that may just be the catalyst that eventually tips the U.S. economy into recession. Technical difficulty here. Bear with me a second. There are still lots of geopolitical wild cards, like the UK leaving the European Union, the US presidential election campaign, the Middle East, Greece, Russia, China, North Korea, terrorist activity, and the refugee crisis, and any one of these that contributes an additional shock to the global economy, or perhaps even some new issue, could also be a catalyst for greater uncertainty. Bond markets provide the early warnings, and the yield curve activity provides clues of timing and direction of moves in financial markets. After a fourth consecutive quarter of negative earnings growth, earnings expectations continue to be lowered for 2016, leaving current stock prices at relatively expensive levels. The trouble is that impatient investors continue to search for growth and are making equities a considerably more risky asset class. The period from 2009 to 2014 was a time of better than average returns for balanced and diversified portfolios, but the cycle of economic activity has slowed, and the lack of growth and inflation are no longer providing those kind of returns. There is a tendency for some investors and traders to pursue greater risk to improve their returns, but we believe this to be a relatively poor strategy. In fact, we believe that investor portfolios need to be revisited and allocations adjusted to ensure that strategies are providing appropriate risk-adjusted returns, consistent with the current investing environment. Okay, well, let's have a look at what's been driving markets over the last week. Volatility has been subdued recently, and it remains well below its long-term average. However, usually spikes higher in volatility follow periods of lower volatility, so we'll keep our eyes open for what's going on next. CNN Money's Fear and Greed Index hit a low near 9 in January, but has moved higher since central banks' easier monetary policy has encouraged investors to take more risk. Markets moved rather quickly from oversold to overbought in March. We believe that the next move will likely take us back to more oversold levels. Since our last webinar, our benchmark world equity index is up by 1% and is now up 2.25% so far this year. China's Shanghai Composite Index was the best performer since last Tuesday. The UK FTSE 100 Index was the worst performer. Now, the TSX has been the best performing country index in the developed world this year. The Canadian REIT Index has also done extremely well, and as I continue to tell people, we have an allocation to the REIT asset class in our global equity model, but have recently done some rebalancing after it had performed so well. The index that we use for our equity benchmark has been trending lower since May of 2015. It is currently testing the upper band of the downtrend channel and getting some selling resistance there. But to date, it has continued to make lower highs as it tests that upper band. The next move should be a test of the lower band of the channel for buying support. That would be a move lower by approximately 17%. Now, the 1 year total return for this index has been 5.3%. The 3 year total return has been a plus 5.5%, and the 1 year total return, as I said, that's a negative 5.3%. And if you combine the equity and bond indices into a balanced scenario, the 1 year total return has been a negative 2.2% for a 60% equity and 40% bond index combination. A positive 4.85% over 3 years and a 5.03% for 5 years. For a less risk-oriented 40% equity and 60% bond combination, the 1 year total return has been a negative 0.64%, 4.55% for 3 years, and just a little under 5% for 5 years. Now, when you're comparing the return on your portfolio, don't forget to include your fees and any MER costs that might be associated with it. Fixed income markets were all a little bit higher this week, led by the Canadian Preferred Share Index, and nat gas led commodities higher. Bloomberg Commodity Index continues its new uptrend, and oil has been the major driver of that move. Now, our benchmark world equity index is comprised of about 53% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy, and we think that it is giving us some mixed signals. We do wait to see who becomes the next president. The latest CNN poll has Hillary Clinton with a continued advantage. I'm told that more conservative polls may show that Donald Trump is doing a little better. Again, we keep our eyes on what's going on here. It wouldn't surprise us to see Trump narrow that gap even further before too long. Well, at their last meeting, the U.S. Federal Reserve indicated it was less worried about global economic issues, but concerned about slowing U.S. economic growth. But on Friday, Chair Yellen said that she sees a rate increase in the next few months. And news today, consistent with the April retail sales data, the consumer came back to life in April after hiding out for most of the first quarter. However, that was already built into second quarter GDP expectations that are continuing to show a growth rate of 2.9%. And this certainly has the U.S. Federal Reserve thinking more about the possibilities of a rate hike, and potentially sooner. Now, however, when interest rates do rise, the costs of servicing debt will also rise. And that's something that does worry us. It's the household deleveraging that had been taking place from 2009 to approximately 2014, but that seems to have ended. And as this chart shows, a growing amount of debt in auto loans and student loans has been pushing borrowing levels back toward the 2008-2009 levels. That is something that would be problematic if interest rates do start to rise in the U.S. Meanwhile, enticed by record low interest rates, companies have increased total debt by $2.8 trillion over the past 5 years to a record $6.6 trillion, according to a Bloomberg report. In 2015 alone, liabilities jumped by $850 billion. Now, for the most part, companies aren't pouring all that money into capital expenditures, and we've certainly discussed this on numbers of our calls in the past, but they have been instead using it to finance share buybacks and increase dividends and make acquisitions. Since 2009, S&P 500 companies have spent more than $2 trillion to repurchase shares, and that's helped sustain a rally where stock prices have almost tripled in that period of time. Higher interest rates would certainly be problematic for corporate debt servicing as well as the consumer debt sector. Now, earnings have been squeezed by lagging worker productivity and mounting labor costs as the tightening job market forces companies to pay employees more. Now, as the profit squeeze continues, that could necessitate worker downsizing. And as we have been talking about in the past few webinars, in the past 3 U.S. recessions, they have followed on the heels of an increase in the unemployment rate that takes it through its 3-year moving average. The rate of decline of the current 3-month moving average, currently now at about 6%, is fast and steep, and if projected, could very well hit the 5% level in a matter of months. Even a slight uptick in unemployment from its current level may indicate that a recession is imminent. We're watching this closely, and that could also be facilitated by the raising of U.S. interest rates. Now, the 4-week moving average of jobless claims has moved higher this Friday, June 3rd. We will be watching the unemployment data a little more closely. It is expected at this point to come in at 4.9%. We'll mention this each week, but the Broad and Diversified Benchmark Equity Index, upon which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed and 23 developing countries. Now, as a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective. So we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries themselves. Now, more than half, as I've mentioned, of the companies are domiciled in the U.S. Europe contains about 16%. There's about 7.5% in Japan, 6.5% in the UK, 3% in Canada, and about 2.5% in China. So let's look and see what's going on elsewhere in the global economy. Like the situation in the U.S., global debt continues to mount as interest rates remain at very low levels. Higher interest rates, of course, would have a significant impact on the debt servicing of global debt, especially that denominated in US dollars. With monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, we are still waiting to see the economic impact of all of that monetary stimulus. And despite the aggressive monetary stimulus and negative interest rates from the European Central Bank, consumer prices have failed to grow for the fourth straight month. Preliminary figures for May showed earlier today. The inflation has been running well below the ECB's target of just under 2% for the past 3 years. In fact, over the last 4 months, consumer prices have been in deflation below that zero level. And the British economy expanded 2% year on year in the first 3 months of 2016, lower than the 2.1% initial estimate and the 2.1% rise in the previous period. It is the weakest growth rate in 3 years due to a slowdown in household consumption, exports, and a fall in business investment. And now with less than 1 month to go until the UK referendum on remaining in the European Union, the stay camp continues to hold a narrow lead. Consumer prices in Japan dropped by 0.3% year on year in April of 2016, compared to a 0.1% fall in March, and matching market expectations. It was the second straight month of decline as the cost of housing and transport declined further, while prices of food increased at a slower pace. So far, negative interest rates do not appear to be stalling deflationary trends in Japan either. And here at home, real gross domestic product grew at 0.6% in the first quarter, following an increase of 0.1% in the fourth quarter of 2015. Exports were the largest contributor to real GDP growth in the first quarter, as the Canadian dollar was continuing quite weak. Business non-residential investment fell 2.5%, and that's the 5th consecutive quarterly decline there, driven by lower investment in engineering structures. Housing investment, though, was up 2.7% in the first quarter, with increases in new home construction, renovations, and resale activity. Expressed at an annualized rate, real GDP rose 2.4% in the first quarter. Well, last week in its decision to leave interest rates unchanged, the Bank of Canada said that the economy's structural adjustment to oil price shock was continuing, but is proving to be uneven. Now, growth in the first quarter of 2016 appears to be in line with the bank's April projection, although business investment and intentions remain disappointing, as we saw in the data moments ago. The second quarter will be much weaker than predicted because of the devastating Alberta wildfires. The bank's preliminary assessment is that the fire-related destruction and the associated halt to oil production will cut about 1.25% points off real GDP growth in the second quarter. Now, the economy is expected to rebound in the third quarter as oil production resumes and reconstruction begins. While the Canadian dollar has been fluctuating in response to shifting expectations of U.S. monetary policy and higher oil prices, it is now close to the level that the Bank of Canada assumed in April. Canadian dollar got to 80 cents U.S. before retreating back towards 76 as the wildfire problems grew. Now, Canada's housing market continues to display strong regional divergences, according to the Bank of Canada, reinforced by the complex adjustment underway in the economy. In this context, household vulnerabilities may have moved higher. In a report released last Friday, RBC economists wave a red flag about activity in the condominium segment in many cities, but single out Toronto with being especially problematic. In the first quarter of 2016, there were almost 6 new condo units under construction across the country for every 1,000 persons, just off an all-time high hit in 2014. This level is well into the high-risk zone, according to the Royal Bank economists, which defines it is defined as anything about 4.5 condos under construction per 1,000 people. Now, of course, this is one group of economists' opinions. There may be others out there that do not consider this as such a big issue. Well, where do we see all of this leading us? Well, let's look at the bond markets as we do. Each week we look at these yield curves to assess what the bond markets might be telling us. A positive sloping yield curve, such as we see in the US, UK, and Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. But a flattening yield curve tends to signal a greater chance of recession in the future. Now, negative yields below that pink zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese yield curve is now negative out to near 15 years. So in essence, you pay to own the safety of Japanese government bonds as opposed to them paying you to borrow your money. Not a good sign for the Japanese economy. And as we saw, 2 more months of deflationary trend is concerning Japanese investors. Since last week, the US, Canadian, German, and Japanese yield curves have remained little changed. The UK curve has flattened a bit with some reduced growth expectations, and a lot of that certainly is pent-up consumer activity that has not been taking place because of the concern over the Brexit situation and referendum. Looking closer at the U.S. yield curve, prior to the Great Recession of 2008, 2009, you can see where the Fed pushed short-term rates up and flattened the yield curve in 2007. If the Fed raises rates, then we can expect similar circumstances to evolve today. Short-term maturity bonds were higher over the last week, higher than were the longer-dated maturities, and that is further flattening the yield curve and a potential predictor of potential recession. As for equity markets and their value, when investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.3 times. The 12-month forward price earnings ratio is currently at 16.7 times. Last week it was at 16.3. At the equity market highs back in May of 2015, it was 17.1. Not only are prices expensive relative to earnings, but after the first quarter, there has been 4 consecutive quarters of negative earnings growth, and expectations are that the second quarter will be the 5th quarter of negative growth. And earnings growth for all of 2016 is expected to be less than 1%. It's hard to expect growth in equity markets when companies cannot grow their earnings. And remember what we were talking about earlier, when companies can't grow their earnings, they may have to start to cut costs in order to become more profitable. That may lead to further unemployment. So we're keeping a very close eye on what's going on there. Corporate profitability, which is that white line that you see, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time around. And stock markets do tend to fall during recessions. As you can see here, in each of the last 3 recessions, stock markets have fallen, more so in the last 2 and more dramatically so in the last 2. So we'll watch and see what happens if we do get a recession in the next 6 months or so. We're certainly thinking that there is an elevated chance of that, and as a result, and as we know how we've been thinking for the last year, we have taken a very cautious and defensive posture to investing, and in light of our key theme for 2016 and with higher levels, potential higher levels of volatility, it has been fortuitous for our clients because the benchmark equity index had declined by over 5%, as we said earlier. So that's been good. We've been lighter equities than normal, than we normally might be. We've remained defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics, some of which we've discussed today, that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. Cash and cash equivalents have been and continue to be important defensive assets, so we're carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, your goals, your risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe will add value to the long-term performance. Rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling those outperforming assets and buying underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while the outperforming assets will ultimately underperform. This is how profitability is realized, and the new cash that we receive gets reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class like the Canadian Preferred Share Index attains a higher level of volatility and becomes less suitable, which it has recently, we will reduce our and your exposure to continue to maximize risk-adjusted returns. On BNN's market call a few weeks back, Paul identified 3 top picks for our models. Paul, do you have anything you want to throw at us this week? Anything new on any of these top picks, or anything else that you might have to say for that matter?
Nothing new on those 3 top picks. They're all still moving in the right direction. Athabasca bonds are moving up, certainly with all E&P, oil and gas exploration company bonds. Given the price of oil today hit over $50 WTI per barrel. Conexus still waiting on Superior Plus's purchase of Conexus to go through. We own both stock and some convertible bonds. Expecting that to come through any day from regulators, and 30-year Government of Canada paper still appears to be fairly well bid as per your yield curve analysis. So all 3 still kind of working out pretty well. That's it.
Tremendous, tremendous. And
we should add, Scott, too, that we obviously have other positions in the tactical portion or the tactical model within client portfolios, but we're not really at liberty to talk a whole bunch about them in a public forum, like on TV and the webinar.
And I know that that's your special sauce, and we want to keep some things that our clients participate in to ourselves, because that obviously is to their benefit too.
Yeah, exactly.
And that also adds, as most of our clients know, we have 3 models that we utilize because our global equity model has been underweight equities and overweight cash for quite some time. The tactical model becomes even more important as a vehicle for our clients to give them a little bit of extra value-added return, and that's something that I think you've been doing a wonderful job at since the inception of that model. So congratulations to you, Paul. All right, well, let's see what's on the docket for next week, or in fact, starting tomorrow, we're going to start to get some of the reports from for May on the manufacturing side of the European Union and what's going on in the U.S. We'll see more of those manufacturing indices reported over the course of the next week in many different countries. On Thursday, the European Central Bank will announce their latest interest rate decision, so we'll watch that closely to see if they're going to take any new steps to try and get out of that 4-month deflationary slump that they seem to be in. On Friday, as I mentioned before, very key employment data coming out of the U.S. Again, we're watching that very closely because of what may be potentially a signal that a recession is not far away if unemployment starts to climb. Next week, not a whole lot of news to talk about. But of course, on Tuesday we will be back for our weekly webinar. Well, that's it for today's discussion. If anyone is listening might wish to ask a question, please feel free to ask. All right. If you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get your feedback on these webinars. And for those who have given me feedback, thank you. It is always nice to know that we're talking about the things that you want to hear us talk about. But if there is anything you would like to hear from us on, we will be more than happy to do so. As always, I want to take a moment to thank everybody for taking the time to tune in. Everybody's got busy schedules, so thanks for giving us a little bit of your time. Have an excellent rest of the week and a wonderful weekend. And don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson, and I'm signing off.